The critical position sizing error is not a mechanical mistake on the tape. It is a moral failure of character. It is a breakdown of discipline disguised as calculation. It happens the instant you allow the sickly warmth of euphoria from a previous win to convince you that the next bet deserves double the risk. The moment your emotions dictate the size of your trade, the precise moment you find yourself sizing up because you feel impossibly confident or sizing down because you are utterly paralyzed by fear, your trading account is already dead. You have forfeited the game. You are betting with your hopes, and the market takes all such bets. You must understand this deeply. Position sizing is the only control you truly possess. Everything else, price, volume, trend, is determined by the anonymous judgment of millions of other men. But the size of your stake? That is your decision alone. That is your sovereignty. If you surrender that sovereignty to your gut or to the rush of adrenaline or to a feeling of certainty, you deserve the reckoning that is coming. You must stop gambling. You must start managing the commitment. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The majority of traders engage in inverse sizing. They commit the fatal error. They size down when the trade is working perfectly. They have analyzed the chart. They have placed the initial pilot position. The market moves decisively in their favor. The validation is instantaneous. What happens next? Fear sets in. They become afraid that the profit, the small profit they have just made, will disappear. They snatch the profit back, taking it off the table too quickly. They refuse to add to the position. They are sizing down out of cowardice. They are limiting the earning power of a confirmed, proven trend because they are terrified of the next small fluctuation. Then the reverse happens. They enter a trade. The stock immediately turns against them. The position is losing. The initial thesis is clearly faulty. Do they cut the loss immediately? No. They look at the red column and they tell themselves a story. They believe they are smarter than the market is acting. They decide the price is temporarily depressed. They convince themselves that they need to average down, or that the reversal is imminent. They size up aggressively on a losing position. They double their stake when the market is unclear, when the ticker is telling them they are fundamentally mistaken, or when they are simply gambling on a desperate reversal. They are sizing up out of ego or out of hope. This is inverse sizing. It is financial suicide. True discipline means maximizing size when confirmation is overwhelmingly strong. It means backing your judgment with the heaviest commitment only after the judgment has already been paid for. And it means minimizing size or cutting it entirely when the analysis is speculative or when the market is speaking against your position. If you find yourself constantly taking small, panicked profits from winners and feeding vast sums of money into losing ventures, you're trading backward. You are financially illiterate. You must correct the geometry of your position sizing. It must align with conviction and confirmation, not with fear and desperation. Never enter a major commitment immediately. The ticker is a dangerous woman. You must court her first. Every trade, regardless of how certain you feel, must start as a pilot position. A pilot position is small, it is insignificant, it is cheap, it is a reconnaissance probe. It is not the main infantry charge. You use this small stake to test the market's reaction to your theory. You are asking the market, do you agree with my prediction about this railroad stock? Are you ready to move? If the market shrugs, or if it turns and strikes back, the loss incurred by the pilot position is trifling. It causes no emotional pain. You have merely lost the price of the test. If, however, the pilot position immediately moves into profit, and if that profit holds and expands, the market has confirmed your view. It is only then that the market earns the right to accept more of your capital. It has validated the thesis. The pilot position is not just a safety measure, it is a psychological shield. If you plunge a vast sum of money into an entry instantly, Every tick against you brings anxiety, doubt, and the pressure to make an emotional cut. The pilot position removes that commitment pressure. It allows you to watch the price action with the detached clarity of an observer, not the panic of a hostage. Only when the pilot position is safe, only when the current price is far enough above the initial entry to absorb a sudden correction, do you even consider adding to the commitment. Test the water before you drown in the deep end. You must understand why winning a small trade is often the single most dangerous event that can happen to the speculative man. It is not the large loss that kills most accounts. It is the small win. The small win is insidious. It does not enrich you materially, but it poisons you psychologically. It inflates the ego. The trader, having made a few points easily, believes he has suddenly mastered the current market environment. He thinks he has the ear of the ticker. He assumes the market is easy, pliable, and predictable. This triggers the early ego win multiplier. The brain tells the trader, "You were right the first time, but you were a coward for making the bet so small. Double the size this time. You know the secret now." This leads directly to doubling the size or tripling it on the very next trade. This next venture is always, inevitably, the one that wipes out the small gain and then takes a severe chunk out of the underlying capital. The trader, drunk on recent success, has now exposed his entire flank to an ordinary market fluctuation. The market has a malicious sense of humor. It gives you $1 to find out exactly where your discipline breaks. Position sizing must be fixed or mechanically scaled according to strict capital protection rules. It can never be based on the recent success of the previous venture. Your sizing mechanism must be a cold, calculating machine. It must ignore the flush of victory. If you allow the feeling of "I am hot" to determine your next commitment, you are a gambler running on luck, not a speculator working with logic. The market will gladly give you enough rope to hang yourself with the hubris of a few easy points. This is the central difference between the common speculator and the professional trader, the principle of the trail. You should only increase your position size. You should only scale up once the original venture is demonstrably profitable. And not just profitable, but safe. The stop loss for the original position must have already moved to break even, or better than break even. It must be a protected trade. Only then are you allowed to reinforce the line. Scaling up on a losing trade is sheer speculation. It is throwing good money after bad. It is a desperate act rooted in the hope that you were right but merely premature. Scaling up on a winning trade, however, is reinforcement. It is backing your profits. It is strengthening the hand that the market has already shown you to be a winner. Think of capital commitment as being proportional to confirmed truth. When the market has confirmed your thesis by moving 10 points in your favor, the truth is 10 times clearer than when you first entered the position. Therefore, that position deserves a larger commitment. When the market has moved 10 points against you, it has confirmed that you are wrong. It deserves no commitment at all. This rule is ruthless and it is absolute. I never reinforce failure. I only reinforce success. The largest positions I have ever held in my life were positions that were already deep in profit. I was riding a trend that had paid for its own capital many times over. You must stop gambling with the initial entry. You must earn the right to the big commitment by proving your initial idea was sound. Let the market pay for the added size. Your position size must be small enough that a full mechanical stop-out does not inflict emotional pain. This is the true measure of your overcommitment. If you lose $500 and you shrug and immediately look for the next clean setup, the sizing was appropriate. You have accepted the calculated risk. But if you lose that same $500 and it triggers panic or immediate rage or a compulsion to engage in revenge trading, if you feel an urgent need to re-enter the stock immediately to get back what is yours, your sizing was profoundly and dangerously too large. The money you risk must be expendable emotionally. If the loss of that risked money compels you to act outside of your predefined rules, the loss has become a psychological blow, not just an accounting entry. Speculation is an intense mental game. Your mind must remain cold, rational, and clear. If your position size is so large that the volatility of the market, which is constant and unpredictable, induces fear, anxiety, or aggression, your sizing has transformed you from a professional speculator into a panicked amateur. Sizing must be a shield against the psychological damage of market volatility. If you are losing sleep over a position, you own too much stock. Cut it immediately. Reduce the size until the inevitable fluctuations of the ticker tape are merely interesting rather than physically stressful. Your mental capital is far more valuable than your financial capital. Do not expose the former to the ravages of the latter. You will be wrong, repeatedly. I am wrong, repeatedly. Being wrong is simply part of the business, but you must control the impact of being wrong. If you incur 3 consecutive mechanical losses, 3 ventures where your stop loss was hit perfectly and legitimately, you must recognize that you are out of sync. The rhythm of the market is currently alien to your analysis. You are seeing ghosts, or you are reacting too slowly. Something is fundamentally misaligned between your perception and the reality of the price action. This demands an immediate mechanical defense. I call this the aggressive cutback rule. If you incur 3 consecutive losses, regardless of the quality of the subsequent setup, your default size must be halved immediately. You have the stake. If you were trading 1,000 shares, you now trade 500. If you lose another 3 in a row, you have it again. You move to 250 shares. This rule removes the discretion from the emotional mind. The logic is absolute. The market has proved you are currently unfit to hold large commitments. Consecutive losses indicate that the trader is reacting to noise or that the current character of the market is shifting quickly. The appropriate response is not to argue with the tape, but to aggressively conserve capital until synchronization returns. You are stepping back. You are reducing your footprint. You are conserving ammunition. You do not increase size again until you have proven you are back in sync by booking 2 or 3 profitable ventures at the reduced size. The moment you think, I'm already down, so I must make this next bet larger to get it back, you have abandoned the mechanic and surrendered to the gambler. The aggressive cutback rule is a fail-safe. It is the acknowledgement that sometimes the best trade is simply the small, conservative one that allows you to live to fight tomorrow. The greatest financial hazards are seldom external. They manifest when emotional impulses dictate contract size, turning controllable risk into a punitive market penalty, the inevitable instructional fee for the trader who refuses discipline. This exact lesson, the catastrophic cost of letting impulse override calculation, forms the bedrock of Edwin Lefebvre's 1923 classic, Reminiscences of a Stock Operator. By documenting the trials of Larry Livingston, Lefebvre offers the serious reader a necessary training ground, a detailed mental rehearsal of Jesse Livermore's costly errors and eventual triumphs, before those costs must be paid personally. To ensure that this century-old wisdom remains perfectly calibrated for the modern financial landscape, we strongly advocate for the Max Davidson edition, whose annotated commentary bridges the gap between the 1923 tape and contemporary trading realities. A link to this essential edition is provided in the description below. View your capital not as mere dollars in a brokerage account, but as finite ammunition in a serious war. Your largest size commitment, your maximum risk tolerance, is your heaviest caliber shot. It is your cannonball. Your small pilot positions are reconnaissance rounds. If you use oversized bets, the bazooka rounds, on every speculative idea, on every rumor, on every trivial fluctuation you see on the ticker, you are wasting your powder. You won't have the heavy caliber shot, the maximum allowable size, available when the clear multi-year opportunity finally presents itself. The greatest fortunes are not made on quick scalps or overnight reversals. They are made on the big move, the sustained long-term trend that lasts months or even years. That big move might only come once every few years. It might be the aftermath of a panic or the start of a great industrial boom. When that moment arrives, your analysis must be perfect, your patience absolute, and your capital ready. If you have squandered your ammunition on frivolous bets, if your capital reserves have been depleted by ego-driven oversizing in the interim, you will watch the big move sail past you from the sidelines, unable to participate fully. You must reserve maximum size for maximum clarity. The power of position sizing is in its conservation. You do not fire the cannon at a rabbit. You wait for the elephant. Be stingy with your size. Protect your purchasing power. The greatest opportunity will not wait for you to refill your account. Sizing down a position in order to average down the entry price on a losing stock is one of the deadliest emotional traps in all of speculation. The market has told you that your original entry was a mistake. You purchased 1,000 shares of a commodity at $50, and it has dropped to $40. You're down $10,000. The disciplined man cuts the loss. He accepts the error. The emotional amateur does something horrific. He decides to buy another 1,000 shares at $40. Why? Not because the fundamental analysis is better at $40. Not because the market has shown a confirmed reversal. He buys more simply to justify his first error. He wants to reduce his average cost to $45 so he feels less pain. He has taken an initial manageable mistake, a small commitment that lost $10,000, and turned it into a major oversized position, 2,000 shares, that is still losing $10,000, but is now absorbing twice the volatility. This tactic uses valuable conserved capital to justify a past error. It turns a small mistake into a major emotional commitment that now requires a massive recovery, a $5 jump in price, just for the trader to break even and escape whole. The trader is now trading for psychological parity, not for profit. Position sizing must be used to maximize returns on confirmed trends, not minimize the pain of confirmed errors. Never, under any circumstances, allow yourself to average down. If you are wrong, you are wrong. Cut the cord and move on. Do not feed a losing horse more hay just because you are emotionally attached to the ride. You must recognize that when you are trading, you are two different people and they must be kept strictly separated. The analyst finds the trade. The mechanic executes the trade. The analyst is clever. He is deep in the balance sheets. He sees the patterns on the charts. He develops conviction. He is excited. He believes he is certain. The decision to enter a trade is based entirely on the technical or fundamental analysis delivered by the analyst. But the decision on position size must be based solely on predefined risk rules delivered by the mechanic. The analyst will always tell you to bet large. He sees certainty where only probability exists. He is prone to ego and arrogance. He says, "This is the best setup I have ever seen." Plunge everything into it. The mechanic must override him. The mechanic must be cold, calculating, and absolutely rigid. His rules are simple: 1% risk per trade. Maximum 3% exposure to any sector. Halve the size after 3 losses. Never allow the confidence, the arrogance, or the excitement of the analyst to override the discipline of the mechanic. The mechanic is the true protector of the account. The analyst is a necessary tool for finding opportunities, but he is a terrible master. The size of the commitment is not determined by the quality of the idea. It is determined by the robustness of your capital protection rules. If your mechanic is weak, your account will bleed out regardless of how brilliant your analyst is. You must be ruthless in maintaining this separation of function. The mechanic is responsible for your survival. The analyst is responsible for your opportunity. Survival comes first. Position sizing is not merely a calculation of how much capital you can afford to lose. It is fundamentally a mechanism of reward. You must not pre-commit massive capital based on mere potential. You are not buying stock. You are purchasing opportunity. The market must earn your commitment. It must prove its readiness to move in your favor. You enter small. You wait. The market must work for you. It must demonstrate directional consistency. It must move beyond the shadow of doubt and into substantial protected profit. Only when the market validates your thesis, when it moves beyond the point where the initial entry looks like a guess and begins to resemble the inevitable trend, does it truly earn the right to accept the largest portion of your trading power. Your heaviest commitment is the reward you give the stock for performing correctly. If you gamble with your largest commitment at the initial entry, you are giving the market a gift it has not earned, and the market accepts gifts only to consume them. The great speculators, the ones who endure, are not those who are willing to risk the most. They are the ones who withhold their power until the last possible moment, deploying maximum size only when the trend is undeniable and the capital is protected by existing profits. Let the market prove the venture. Then, and only then, back the winner with your full commitment. The critical position sizing error is the failure of character disguised as a mechanical oversight. It is the moment you allow greed to determine your exposure. It is the moment you allow fear to limit your conviction. You must understand that the market does not care about your fundamental predictions, your technical analysis, or your hopes for the future. The market cares only about your exposure. The only thing you control is the size of the bet. Discipline is not found in prediction. Discipline is found in the ruthless mechanical control over how much you allow yourself to lose, and how much you demand the market prove itself before you commit. If you master the size of the wager, the market can no longer master you. You have taken the teeth out of the beast. Go back to the tape. Re-examine your failures. Write your mechanical sizing rules down on paper, and never break them. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy and theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called the Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.